Hey everybody, welcome back to the ZSuites YouTube channel. What we're going to be discussing today is investing. Now, my first suggestion is going back to my previous video and understanding your budget. Once you have a grasp of your finances, you'll be able to find the little bit of money that you're wasting on excess spending, and hopefully when applying these principles, you can turn it to a fortune in your future. Now, if you're operating negatively, like money in is less than money out, then take a step back. Look at what's causing that issue, and then we can discuss how to move forward. And with that being said, my first step would be is have an emergency fund. Even if it's $1,000. So many people can't afford an unpredicted expense. But the thing is that we know it's bound to happen. We just don't know when. So if we have this little cushion off to the side, we know that we'll always be comfortable with where we're at. We won't have to dip into any of our investments or rely on borrowing to cover these expenses. We will have what we need and we won't have to pull from ourselves. We have that there for a reason. And ideally, it's 3 to 6 months of our expenses. But know that that is just a goal. Don't allow that target to stop you from using your money in better ways. And that leads me to my next suggestion, which is paying down debt, especially that has a high interest rate. When you pay down debt, you're securing a return on your money. But many of us have a credit card balance that's revolving month over month. We have that interest charge that just pops up on there that we ignore, but want to invest. How does that make sense? I want to put my money somewhere to hopefully make 5-10%, but I have a debt that's costing me 15 to 20%. That is a net negative. You are not making any money. Even if you make 15% in the stock market, you got charged 20% on $5,000 when you got $1,000 working in the stock market. You have to look at the big picture. We're not trying to raise our top line. What we're trying to do is raise our bottom line. How much are we keeping at the end of the day? Not how much we make when we have a bigger expense thrown in the middle that's getting us to a lower number on the bottom. Smart decisions will lead you to better places. And that leads me towards the need to learn to invest in yourself. Whether that be education, a trade, your own business, this investment can change your entire life. Think about it. If you invest in yourself, say I make t-shirts and I can buy these shirts for $10, but I have a clientele that was willing to pay $25 for those t-shirts. I sell 25 shirts, spend $1,000 and turn that into $2,500. But that's not it. If I can see that the demand is still there, that people like my product, that can be reoccurring revenue. Have a clientele. Feed their need, become a producer and not be a consumer. All of these celebrities that have merch that they sell for $60, it's not the fine linens from Italy. It's a regular sweater. It's a regular t-shirt. People just identify with the brand. Be a brand. Be relatable. Start focusing on satisfying the needs of others instead of making money, and you can watch the audience grow organically. Understand that you are your greatest investment. There is no other stock company person that you have this much control over doing, saying, acting. If I need to work harder, I can work harder. If I need to say something differently, I can say it differently. Basically, I control my future. And now that leads me to real estate, where most wealth in the United States has been built. And that can be through asset appreciation, fix and flips, REITs, rental real estate. There's limitless possibilities. And that's why this is my next investment step that I'll be taking for sure in the near future. There's a lot of research that goes into real estate, whether it's understanding a market, picking up on the demand, understanding comps, understanding macro issues, general house values, but most importantly, how to find a deal. It doesn't matter if real estate is overpriced, underpriced, priced perfectly. There's always a deal to be made. That's how you distinguish yourself from an average investor to a successful investor. You can identify those key drivers, the little things that give you a competitive advantage over those in the market that will put you in a better position. So rest assured, when that time comes, I'll be documenting the entire process from start to finish, whether it's open houses, finalizing a mortgage, and turning the last screw on that property. It'll all be laid out for you to be able to learn from my mistakes and also prepare yourself for what you can expect in the future. Now, let's discuss 401ks. If you call up the benefits team at your company and they have 401ks available, sign up immediately. Why? Because you're already too late. It's an easy, low maintenance, it's literally passive investing at its finest. You choose a fund, whether it be Fidelity or Vanguard. There's a wide array of well-established, long-lived funds that have consistently done double-digit gains. So you can't really mess up on that. But where you can mess up is waiting. This is a classic wealth-building tool. This will allow compounding to work its magic. We'll discuss how that works later, but it is something you need to start immediately. Another reason why is because of the employer match. Some companies will match dollar for dollar, others 50 cents for every dollar that you contribute. But think of it this way. If the market stays flat and your company matches dollar for dollar, then you would make 100% on your investment. That alone is enough for me to sign up right now. Obviously, there's vesting periods and tax implications. Say you leave your job, do not cash it out. Roll it over into an IRA or to your new company's 401k. Do not cash it out. You will be taxed. You'll be hit with a 10% penalty. You can potentially lose out on unvested contributions as well. And now here we are with hands-on investing, dipping into the stock market. There are countless brokers out there like TD Ameritrade and Fidelity, but there's also apps like Robinhood and WeBull. There's a link in the description to download both of these apps where you can get 1 or 2 free stocks. And if we learned anything, don't pass up on free money. This is an infinite return on your investment. You don't have to put any money down. You can deposit it, get your free stock, sell it, take the money out. It's a no-brainer for me. And as you invest, you'll need to stick with the broker, so might as well look at both of them and see which one is best for you. I personally stick with Robinhood. It was the first app that I started investing with, so I'm just used to the interface. It also has a wide array of features, whether it's dividend reinvesting, fractional shares, options, cryptocurrency, and so much more. WeBull does have better charting and analytical features, but it's really up to you. So download them both, see what you like, stick with it. Now, I'm sure you've seen the infinite amount of tips and pointers of investing, but they all boil down to 2 things: time and consistency. So to provide an example of this is we have early bird and late bloomer. They both have $250 a month that they contribute to their account that yields 6%. However, the 2 distinctions between these 2 people is that early bird invested for 5 years from age 20 to 24 and completely stopped at that point. They left their balance in the account to grow. However, they didn't put any additional contributions in. Late bloomer, on the other hand, he didn't invest those 5 years at all. However, he said, I have $250 a month going forward. I can do that for the rest of my life. So they continue to invest all the way to, let's say, 40 for this example. You'd expect that late bloomer would catch up pretty fast because he's investing the same amount of money that early bird once did. However, that is not true. It takes the late bloomer 2 additional years of contributions just to match the balance that early bird has. So that is going to be $6,000 more of their own money in the account that gets them to the same balance. That's not even the same amount of profits. That variance is still sitting there. They only made $5,000 over the 7 years that they've invested, but they still haven't reached the $11,000, $12,000 that late bloomer has by just investing early and letting the balance sit. So at what point do they match the profits of each other? That's not until 39 years old. That's an entire 15 years that the late bloomer had to invest consistently to match the profits or exceed the profits of the early bird. And that's just something that you need to understand how this all works. Being early at investing is so important. You can't catch up with the same amount. You have to work so much harder the later you start. So it's important to start now. Start immediately, whatever you can do, because that will just allow compounding to work its magic. So at the age of 40, the late bloomer will have an $81,000 balance. But let's just say that they were able to scrape up $150 a month in those early years that they chose to not do anything, whether it's because they were young and they wanted to go out and party, or they just didn't have the job, or they didn't have the hustle to want to earn more money. Maybe they're in school. There's a bunch of excuses that happen in the world. It can be whatever the reason. You can find the money if you want the money, period. So if they did that extra $150 a month, their balance at 40, $109,000. That's almost a $30,000 swing on how much more in contributions? $9,000. Compounding will work its magic. You just have to let it work. Spend the most time possible being consistent. So to drive home the phenomenon of compounding interest, think of it like a snowball. As you invest, your balance starts to grow. As your balance grows, you're able to get more gains. The more gains you have, it increases your balance. So on and so forth until you reach a balance that you didn't think was attainable. Think of that $250 a month that you're investing, and you did that for 40 years. That will lead you to a portfolio balance of nearly $500,000. Take a step back. $120,000 of overall contributions gets you to a balance of $500,000. Now, what if you did $500? What if it was $1,000? It's all on you, whatever is comfortable for you. But being consistent and early are two things that you cannot forget. These are the most important things when it comes to investing: time and consistency. Now, there's a lot of ways to invest. You can follow an index fund like the S&P 500, where you're kind of betting that the US will continue to grow. And if you think that's the case, great. You can find that as SPY on Robinhood. Or you can go towards blue chip stocks or dividend stocks. These are the big boys that you hear about every single day. These are the apples of the world: Amazon, Coca-Cola, Bank of America. Me personally, I avoid bank stocks, but this is my disclaimer that I'm just a random guy on YouTube, and anything that I say and you follow will lose all of your money. So don't listen to me. But these are companies that are seen as strong, sought after companies that will withstand downturns and hopefully in the future continue to grow in value and maintain the dividends that they have or possibly increase them. Now, if you don't know what a dividend is, it's basically a thank you check for owning our stock. And that's separate from any appreciation that the stock may have. But think, this is a second layer of compounding that can start to happen. If you reinvest those dividends into the stock, you'll eventually have more stock. And in turn, you'll get more dividends. And then you'll have a duplicate layer just continuing to grow. This is all about consistency. This is all about staying in the game for as long as possible. Then there's the BYOP, build your own portfolio. This can be a mix of well-diversified companies that cover different industries, certain business life cycles, and hopefully they all have a strong financial position. And by financial position, I mean, are they making money? Do they have cash in case there's a negative downturn in the economy? Are their sales on an uptrend or a downtrend? Is the stock priced way above how much they earn? I know these sound like archaic ways of judging the stock market, but these are tried and true methods. The stock market will not always go up and up and up. That is not how business cycles work. That is not how equities work. There's always booms or busts, and you need to be prepared to withstand any downturn. So think of the companies that you want to own. Do you understand their product? Do you see them growing in the future? Are they innovative? Do they impact the world that you live in? Why Zoom increased over 400% since the pandemic started. There are opportunities everywhere. You just have to know what to look for and be prepared. To summarize this all, the main principle of investing is allow time to work its wonder. Start as early as possible because the catch-up game is tough. Do not compete with anybody else. Challenge yourself to be the most consistent investor that you can be. And please do not panic sell when things get rough. And that's not me saying don't ever sell. If you need to restructure, do so, but do not sell because you think it might go down further. You must evaluate all information that is available to you and make the decisions off that, not off your emotions. Warren Buffett, probably the most well-known investor, has two rules, and I'm sure you heard them. Rule number 1 is don't lose any money. And rule number 2 is don't forget rule number 1. This is a true token, but it also fits into the narrative of you don't lose until you sell. Now, I personally looked through the monthly data of the S&P 500 all the way back into the 1920s, looking for any statistical confirmation of long-term investing is the right way to go. And whether it was a monthly return, 3-month weighted average, 1-year weighted average, or 3-year weighted average, which all pointed to a statistical probability that you will earn a positive return the longer that you invest. So be sure to stick to the script and be strong during any downturns. You need to start on your long-term portfolio. Get your money working for you. Also, keep an eye out for any opportunities that present themselves. Have some cash put over to the side so you can strike immediately. I hope all of this information was valuable to you and you can apply it to your life. Let me know if you have any questions or comments on the information that I provided to you. Like, comment, subscribe. This is ZSuites. See you at the top.